Okay, good afternoon, everyone. Kevin, thank you for the introduction. As mentioned, my name's Ian Mace. I'm the Global Head of Maritime Trade and Offshore Finance at Stephenson Harwood, and it's a real privilege, Tobias, to be interviewing you today. We've obviously known each other for a long time. Very distinguished career, and I think we've obviously worked together on quite a few transactions as well. And I think when I was preparing for this together with Tobias, what was really interesting for me is just the perspective you bring on this particular topic around, capital solutions, because you're obviously very well known in the market, but people may not know that you actually spent 13 years in the banking sector before the last 17 years being in the private credit space. And one of the things that I found working with you, but also preparing for this, is just the way that you view things is quite different, because a banker's perspective is one view, but private credit is very, very different. And having that different lens is something I'm hoping is going to come through in our interview today, because I find it very, very interesting. And I hope everyone else does as well. But currently at Pelagic Capital. For those in the audience that don't know, Pelagic it's not a new group. It's formed in 2019 as an equity fund. Since 2020, acquired 28 vessels. But the credit strategy is a new one, with you joining the team. And it's very much building on the credit strategy that you previously employed, both with Icon and with the Fleetscape platform that was owned by Oaktree. So obviously, your addition to the team brings that credit platform strategy with you. But why now? That's my first question. Why now? Why is this the right time for Pelagic and yourselves to be embarking on a new credit platform focused on the shipping space?
First of all, thanks for having me. It's a pleasure to be here and also with you. We've done a lot of deals together. I think the simple reason for why now is that investors want to be in the space. I think the shipping market has shifted quite a bit. When I started my career in the banking world, the vast majority of shipping was funded by banks. And then I often refer to the most overused chart in shipping as the chart showing that in the last 15 years, bank portfolios have shrunk by a third as the global fleet has grown by a third. And the only way to address that shortage is to find alternative sources of capital. And I don't think there's one solution to all of it. I think you need a little bit of everything, the significant capital need that needs to be filled.
And I think, in terms of the timing, though, I think some of the other panels have touched on this in terms of that need for capital, that need for creative solutions. Do you want to talk a little bit about some of the things that have happened? USTR is an obvious one that's been mentioned already today. A few of those things that have really meant that now is a very good time for private credit in shipping.
Well, I think we're seeing a big shift among the investor base, not only in shipping, but I think in the broader markets, there's a huge inflow into the private credit space in general, and I think we're seeing it both in terms of demand from clients, but also from the investors. Most of our investors are actually people quite familiar with the shipping space. In the past, when ship owners made money, they would go out and order more ships, or they would put it into real estate. Those two investment strategies are not particularly compelling at the moment. And they're looking for other ways to deploy capital. And what we do is a very natural extension, right? You're still in the maritime space, and you're investing in a different way. So we're seeing the investors want it. And then shipping clients need to find different alternative ways of funding themselves. Where we really excel on finding solutions for clients. And then if you just want funding for 50% of a ship, then go to your shipping bank, go to the Chinese leasing solutions. But if you need anything that's a little bit different, anything that requires a little bit more creative thinking, you need to work with people who can solve a problem, not just provide a funding.
I think there's two or three kind of key words in there. Solution-based is one. I'm going to come back to that. But the thing that you mentioned at the start was really about kind of investor appetite. And I think 2025 was one of those years where it was mentioned on one of the previous panels that the amount of liquidity in the market at the moment is astonishing. And 2025 was a year when, both from an equity perspective and a credit perspective, there was a lot of activity from institutional capital. We saw KKR, Apollo coming in on LNG deals from an equity perspective with Cape Omega and Have Energy. But then on the credit side as well, we've seen a number of groups, yourselves included, raising really significant amounts. I mean, we saw Northern Shipping Fund announce, what was it, Fund 5 for $750 million. So really significant sums. But in terms of your capital raise and the investor appetite, there must be some challenges on the way. But how have you found that kind of credit raising environment over the last year or so?
Well, fundraising is a lot of work, and it takes a long time. But you learn a lot of things along the way. And one of the things you figure out fairly quickly is to get money from outside of the industry into shipping is not that easy. It's not that easy for a few different reasons. I think if you look at institutional investors that have come into the shipping space, not so much the sort of smaller LPs, but the big financial institutions that look upon the market and they go, well, shipping is similar to aviation or it's similar to real estate. They've often lost money. They've only generally been successful when they've actually teamed up with shipping teams, internal shipping teams. That's when it worked out well. And I think you made the referral to KKR is a good example. I believe their investment in Ocean Yield has worked out quite well. They invested in an established business, but they had some that didn't work out that well before that when they tried to do it on their own. So I think that's a familiar pattern we're seeing.
And in terms of the other kind of components of the capital raising environment, I mean, capital raising through investors is one, listing and bonds and others, back leveraging, the types of things that you need as part of an overall credit platform strategy. How have you found the environment for each of those to the extent that you've been looking at them so far?
So I think at the end of the day, we are another product. We are, if you go back to your original introduction, if you will, I started my career as a banker, and now I do alternative lending. And I think a lot of people look upon that as, well, you're basically doing what you did before, but at a much higher advance rate. That's not really what's happening, and I think that's also why not that many bankers have made that transition successfully. Not that many lending institutions has made that successful sustainably. And the reason is that you have to look at the situation very differently. If you're doing what we do at Pelagic Partners, we are taking more risk. When you're lending at a higher advance rate, you will end up in situations where there'll be bumps in the road, and you then have to be nimble and flexible enough to deal with those situations without really creating more of a problem. At the same time, the way we make money is to find the right deals, clearly, but often more importantly is how do you fund these deals? And versus in a lending institution or in most other investing situations, your funding source is fairly standard. What we do is we probably spend more time on optimizing how we deploy capital in each individual transaction that we do. And that will drive the return on investment we make and also drive the cost of capital for the clients at the end of the day.
You mentioned being a banker as well, but because back leveraging, as I said, is obviously part of what you need. And we heard on the bank panel about there are some challenges there, but you, as you say, you're going up the risk curve, and a lot of what the bank panel was saying is there may be need for banks to go up the risk curve as well. How are you finding kind of bringing banks along with you as you're moving up the risk curve from a back leveraging perspective? Is it from a deal by deal basis, which obviously has its challenges because a deal by deal, it's time consuming, it's expensive, or is it more from a kind of a securitization umbrella perspective, where are you finding the most engagement, as it were?
I would say all of the above. I think where the market has shifted, and this is really more bank regulatory issue than anything else. Banks can lend to a ship and a ship owner and a certain risk-weighted capital allocation. If they give the same amount of money to me and I on-lend it to a shipping company, their risk-weighted capital is lower. Therefore, we can be much more efficient in how we distribute capital in that situation. That may not seem fair, it might seem inconsistent, but that's the reality of how banking rules have happened. And the reason for that is that if you look at us as a financial institution, and most of our competitors for that matter, we have a larger balance sheet than most shipping companies. We have stable income because we charge interest and principal and fees. And that rates better in a bank's internal rating systems. The biggest challenge a shipping loan will have in the bank rating system is volatility of earnings. And we can then be the in-between to make that more efficient overall.
So that kind of brings us on perfectly to the kind of the capital stack, doesn't it, in terms for small, medium-sized shipping groups in particular, because when you're talking about, you've alluded to it already, when you're talking about banking and bank financing being available, it's generally for the bigger companies, the blue chips. It was again mentioned by Kai on the bank panel about how the capital stack, there's room for everyone. But in your opinion, given how most small, medium-sized companies at the moment have limited debt, lots of cash, how do you think that capital stack is going to change over the next 12 to 24 months for those types of groups?
I mean, yeah, you definitely have to change. I think we today, I think the industry has enough bank capacity. But if we are heading into a downturn, which we eventually will, inevitably will, there won't be enough capital. And you need to diversify your funding sources. Ironically, I think as a financial institution, our funding sources will probably be sufficient, either from banks or from other financial institutions funding us. But for the traditional ship owner who had 30 choices to go to 20 years ago, that market is clearly changing and clearly shrinking.
And then in terms of kind of putting capital to work, different sectors at the moment are going through kind of different stages. We're coming from historical highs, but as you say, the market is going to have a downturn at some point, a market correction, however you want to describe it. Where do you think, from a Pelagic perspective, the best opportunities are going to be again in the next 12 to 24 months as maybe that market correction continues?
The best opportunity and the best deal is the last deal that we did. So if you want to know what the best opportunity market is, check our press releases. I think at the end of the day, a person wearing a suit in a tall building in New York or London should not be determining where the next opportunities are. That's where mistakes are made. I think what we have to do is to make sure we pick the right clients and follow them. They're the ones who know what the market opportunities are, and we need to be a funding source and a funding partner for them. I've seen so many examples of people sitting in the office and spending 2 months on the internet and becoming an expert in a certain market segment and it not working out. So I think learn what you don't know before you learn what you do know. Critically important. I have my own opinions about where I think the market is going, but I try to not listen to that as much as possible. I think, again, focus a client, follow the client. That's when you'll find the right opportunities.
It's quite interesting, though. You say, find the client, follow the client. It's, again, very similar to what Stephen said on the bank panel about trusting the client. It's very different for other credit platforms. Some are very vocal. They say, well, we don't fund clients, we fund assets. Why do you think your approach is better?
Well, I think there's probably a need for everyone, to be honest. And honestly, we don't really face that much competition on what we do. When we lose deals, it's because the deal itself doesn't get done. When we lose deals, It's because the owners decided to not do the investment or to use their own equity for the project. But I believe I think our focus is the right one, otherwise we wouldn't be doing it. And of course, in this market that we've had the last several years, nobody's really been tested. I think the real test for what we all do will come when the market falls. And I think in that situation, you're best off having an operator that's been in the rough seas before and knows what to do when the cash flow dries up. And so that's why we are following this strategy that we believe in.
But then presumably, if you're following the clients, and as we mentioned at the beginning, you've been in private credit for 17 years now. During those 17 years, you have seen, with different institutions, the ups as well as the downs. How is your current investor base, which is slightly less institutional capital, a bit more kind of private investors, how does that interaction maybe change the way that you would be able to work with your customers when the market's a bit tougher?
Well, I think number one is if you don't believe that we can manage this in a downturn, you shouldn't be investing in us. And I think the people who have given us money to manage believe in us. And when I say us, I mean, we have a long legacy in this business. The Pelagic Partners is owned by Niels Hartmann and Atef Abumeri. The Hartmann Group has been investing in the shipping space since the 1980s. Really from day one, they've invested on behalf of business partners. The Abumeri family has been invested since the 1990s, again on behalf of other investors. When they got together in 2019, Niels Hartmann and Atef Abumeri, they then started investing equity investments together. And that seemed like it was new, but again, it's building on the legacy of those two individuals' families. And it was very natural then to add a credit platform on top of that, so that we have the ability to deploy capital for investors throughout the market cycle, which you can do for credit. You can't always do it for equity. And I think people believe, they look at the track records of those two families, and they've seen the successful track record. They've seen what I've done in the private credit space, and you believe that we are prepared for the downturn, that we believe we will make money in the downturn. We believe we're prepared for it, and we believe we can take advantage of the downturn when it comes.
And I think probably two last questions. I think the first one is, again, going back to something you said at the start of the interview, was about creative solutions. I mean, one thing that you and I have been working on a number of occasions recently is preferred equity transactions. Everyone's familiar with bank debt. Over the last decade, everyone's become familiar with sale and leaseback transactions, but preferred equity is something that's slightly different, kind of filling that gap. Can you just maybe just in a couple of sentences, just go through some of the things that you think might be interesting for ship owners in that space that Pelagic can offer?
I think at the end of the day, what we do is we price risk, and we structure the optimal transaction for the right situation. And that means that we don't care that much necessarily if it's a loan or a lease or pref equity. It depends on what that transaction needs. And it's become more relevant these days to use pref equity as an alternative. Pref equity is essentially, to make it simple, if you pay for your operating costs, you pay for debt costs, whatever's left over is distributed as a dividend to different stakeholders. It could be a junior loan that gets done after the senior loan, but if you don't pay a junior loan, you're in default. If you don't pay your preferred dividend to a preferred dividend investor, you're not in default with your loan agreement. You're behind on your preferred dividend obligations. And there can be some benefits in that, especially heading into the down market. The reason we're okay with these structures in the right situation is if we believe we will ultimately be paid on the investment on the long term, whether you call it debt or equity, we will find a way to get our return. We will find a way to get paid. And there's some other structural elements to it. Some banks don't want to have another lender behind them. There might be tax considerations involved, and we're actually doing a pref equity deal now where it's an easier way to manage the foreign exchange risk by structuring it in this way. It may seem odd, but that's the ultimate conclusion we came to. So again, it goes back to the same thing. We have to be flexible, we have to be nimble, and we have to be creative in this downturn that's coming.
And then the last one, if Kevin will allow me, thank you so much. It's probably the one that everyone wants to know. You obviously left Fleetscape before the sale was completed. You wanted to do something new. What are you doing that's new? What are you doing that's different this time around?
In many ways, it's very much the same. But I think if you go back before Fleetscape, I think I went from the banking world to alternative credit for a fund in New York called Icon Capital. We had two big challenges. Nobody knew who Icon was, so you had to actually market that to the shipping space. And then the other thing is nobody in Icon knew anything about shipping, so you had to educate the organization about shipping. And we did quite well on both of those two things. It was a good return for the investor, and I think we created a good name in the market. We then took that strategy to Oaktree. In Oaktree, you don't have a problem telling the market who you are. It's quite well known. Now that became a bit of a strategy too, a struggle too, because Oaktree also has a distressed debt strategy, which is quite successful and they're done well, but it's a bit challenging to convince good client of yours that we're not scary if your neighbors are opportunistically buying their debt. So that became a big challenge for us. We don't have that at Pelagic. I'll come a little bit back to that. And then the other thing, the challenge we had at Oaktree was, even though Oaktree had invested almost $6 billion into shipping space when I joined, there was no shipping strategy at Oaktree. And most big investment funds don't have a shipping strategy. We as an industry are simply too small. So there are different teams in these large institutions that selectively invest in shipping. So there are many different investment strategies. That's a large way of saying that the challenges we had at Icon on educating the internal institution about what shipping was remained at Oaktree. So then move on to Pelagic. It's owned by ship owners. Obviously, there's no need to tell people what shipping is. They're quite familiar with the market. And then the other thing it's been very positive to see is that people liked working with the Hartman Group and the Albemarle Group and Pelagic partners. So when we first closed our first deal, we actually got an inflow of deal requests. They saw that and they said, wow, we want to do something very similar with you. And that has been a very good, very positive experience. And I have to say, as a platform, from my perspective, this has been the best platform to develop a strategy that I've really been working on for the last 16 years, 17 years.
Well, I think we're going to have to call it a day there, but very much, part of the solution. I mean, obviously, private credit's been relatively quiet for the last few years, for obvious reasons. My opinion is the time is coming, but that equally there's room for everyone, which I think is a message that's come loud and clear from what you've been saying. And the nature of the group, the nature of the investors is going to make it a smooth sailing for your customers as well. So thank you so much. Really enjoyed it. And thank you, Kevin. Much appreciated.
Thank you very much.